top CEOs gathered at Barclays Global Tech Conference. Now, we had the opportunity to sit down with some of those business leaders, as well as analysts and investors, getting their take on the excitement surrounding AI, as well as some of their top stock picks and big ideas for 2024. Here's a roundup of what they had to say. Juniper Networks is ramping up its focus on AI. Now, the technology has really become a cornerstone to the company's strategy. They're using it to drive long-term growth and also improve profitability. Here to discuss that and much more, we want to bring in Rami Rahim. He's the CEO of Juniper Networks. So Rami, it's great to see you. Thanks so much for taking the time.
Thanks for having me, Seana.
So let's talk about those AI investments, because that really has been the hype word, the word that everyone, the buzzword that people have focused on over the last 12 months. In terms of what it's done for Juniper's business, what are you seeing?
So AI is definitely not a new thing for Juniper. We've actually been investing in this technology for the last 5 years. Our AI-driven enterprise business has been performing phenomenally well. In fact, our Mystified, what we call our Mystified solution, which is driven by AI technology that's essentially enabling us to run networks more efficiently, delight our network operators, delight the end user, has grown over the last two reported quarters approximately 100% year over year. This doesn't happen by accident. We're taking share at an unprecedented rate, and this is proof that AI is not just in its hype cycle, it's proof that AI is actually delivering real results for our end customers.
So because of that, you are already seeing a return, you're seeing the impact from AI, your investments there on your revenue. How is that then shaping your strategy going forward, those future AI initiatives?
Yeah, it's a great question. So thus far where we have benefited is in what we call AI operations. We have an AI engine that's driving network operations and improving the experience to the end customer and to the network operator. The future, I think we continue to do that. We will continue to benefit from the differentiation that we're seeing through AI, but we add yet another area of investment that I think can represent a multi-billion-dollar opportunity, and that's around the AI infrastructure, right? Anybody that is leveraging AI needs to essentially tap into large clusters of GPUs that are connected through networking. Juniper is really good at building high performance, highly efficient, highly reliable networks, and we're doing that to capture this clustering opportunity for the AI infrastructure in the future. That's a next new big opportunity for our company.
And because of maybe some of these initiatives, you also had recently announced a bit of a restructuring. It also included layoffs. What's your message to investors in terms of why this makes sense, some of the strategies, some of the moves that you have done so far, why that makes sense for Juniper in the long run?
Yeah, we had to do a relatively small restructuring effort. We obviously don't like to do these things, but we do them for a couple of reasons. One is we are committed to not just growth, but profitable growth for our investors. But even more importantly is to ensure that we're investing on the right side of industry change. So essentially we are investing and hiring in new areas around cloud-delivered capabilities, AI technologies, data science that will ensure that our solutions are going to be differentiated today and in the future.
When it comes to some of the strength that you've been seeing in your business, enterprise really sticking out, especially in your most recent quarter, in terms of that momentum as we look ahead to next year, what do you see?
So the investments in AI have mostly today benefited our enterprise business. And Juniper has traditionally been known as a company that serves service providers and cloud providers. In the last reported quarter in Q3, enterprise, for the first time in the company's history, became over 50% of total revenue. And I expect that enterprise will continue to grow faster than any other of our segments. That's great, because right now, our superpower as a company is the diversity of our business. We don't just rely on one or two market verticals. We rely on three key customer verticals: service provider, cloud provider, and enterprise. And that gives us the resilience to overcome any industry headwinds and macro challenges that might affect one or two of those verticals.
Talk to us a little bit more about some of those macro challenges, the fact that there's so much uncertainty looking ahead to next year and beyond. As a CEO of Juniper, how are you evaluating, or I guess how are you approaching that uncertainty in terms of some of the decisions that you're making?
Yeah, it's a good question. Again, I think our superpower is our diversity. And right now, for example, cloud providers and service providers are experiencing a period of headwinds because they're digesting a massive amount of infrastructure that they have bought over the last several years. They need to consume it, to deploy it, and so on. Enterprise, relatively speaking, is much more robust. And for that reason, we're relying on enterprise, which again now represents the bulk of our business, to achieve sustainable long-term revenue growth.
Rami, one of the topic points that came up on your most recent earnings call was inventory, the levels that you're seeing there, elevated inventory levels. In terms of that normalizing, what does the timeline look like for that?
Yeah, so next year revenue growth will be muted because of the fact that much of this year's revenue growth has been from the depletion of that inventory. I think as you get into next year, inventory levels should be sort of back to normal. And at that point, orders will start to recover, which is why we expect orders across the board in all of our customer verticals to recover meaningfully next year.
As you look ahead to 2024, what would you say, or can you identify maybe the biggest risk or some of the biggest challenges that are ahead for Juniper?
I honestly feel really good about our competitive position. Our differentiation that we enjoy hasn't been this strong since the birth of our company that I was fortunate enough to see, close to 30 years ago. It's those factors that are outside of our control. How long will it take for the digestion period in the cloud provider and service provider to play out? I am very confident that cloud providers will need to eventually invest in their networks. It's just going to take a bit of time, and that timing is a little bit uncertain right now.
Rami Rahim, thank you so much for taking the time to join us here, CEO of Juniper Networks.
Thanks so much.
Two of the dominating themes here at Barclays Global Tech Conference is AI and cybersecurity. So let's talk a little bit more about how AI is reshaping the cybersecurity landscape and also what we could expect in terms of some of the themes for cybersecurity in the new year. And I want to bring in Shlomo Kramer. He's a co-founder and CEO of Kato Networks. Shlomo, it's great to have you here. Thanks so much for taking the time.
Thank you for having me.
So let's talk about the impact of AI on cybersecurity.
Right.
What exactly has that impact been so far?
So I think there are two dimensions to the impact. One is new types of attacks, right? Mainly deepfake, and how do you know this is real or not? That's becoming a much bigger problem with an AI. And the second is just industrialization of attacks, right? So if it's a human being behind the attack, there's a certain pace to the attack. If it's an AI machine, that becomes much faster and much broader, much more quickly. So really the defenses needs to keep pace with both new types of attack and new scale of attacks.
And how are you doing that at Kato Networks?
By using AI, of course.
Which is so interesting. So when we talk about the fact that we are using AI to kind of fend off some of the risk that AI poses, how are you doing that? And I guess in real time, how much more effective is it for you at Kato Networks in terms of recognizing some of those attacks?
So first of all, AI for us is not new at Kato Networks. We've been using AI since day one as a cloud service, as the largest SASE provider in the world. We used AI from day one to collect all the data from our customers and run algorithms and find attacks. So this is just a continuation, and now with the large language models, which is the next generation of AI, this is very much part of our roadmap and what we embed in our solution. So that's an ongoing, like a Red Queen race, if you want. You have to run as fast as you can in order to stay in the same place against the attackers.
And how would you categorize, you're a veteran of the industry, you've been around for many new breakthroughs, many new technologies, in terms of what AI is doing to your industry, more broadly speaking, touching almost every single industry, comparing that to some of the innovations in the past, how does it stack up?
That stacks up with the iPhone and with the personal computer and with the internet, I think. That's at that level of importance. So absolutely, that's a real revolution, and we are just beginning that revolution.
When it comes to demand for your business has grown dramatically over the last several years. Right now you have about 150 million, I believe, in annual recurring revenue.
More than that, yeah.
Okay, so you have more than that.
More than 2,000 enterprise customers, yeah.
So going off of that in terms of how quickly you've been able to scale your business, what's the next step, do you think, for Kato Networks?
I think that for us, we are both going up market and delivering the powerful simplicity of SASE to larger and larger enterprises. And we are expanding the value of our platform. Really, more capabilities delivered with zero TCO to our existing customers, so we can really partner and be more strategic for them.
And when it comes to some of those partnerships, even some of your customers here, you have a bunch of very recognizable names when it comes to Carlsberg, Porsche, Formula E, Ring
Right.
Central. In terms of their priorities, where they
Right.
lie, what are you hearing from them just in terms of the biggest risks that they are a bit fearful of, and how you then can help mitigate some of those risks?
You know what? I think that the biggest risk for them is complexity. Is the I don't know if you ever been to the RSA show and saw all the thousands of booths that now you need to consume all these point solutions. The complexity is the danger, and when the CIO of Carlsberg tells me that we are the Apple of network security, that tells everything. It's all about the how and how to consume all of these capabilities more than exactly the what. The what is there, the how is not there in cybersecurity.
So what does that mean then just in terms of growth then, the opportunity that lies ahead, the fact that there is such a need for this, and it almost sounds like we're still very much in the early innings.
Exactly, so it's all about the platform, right? And delivering a platform that can bring more and more capabilities without additional cost and additional complexity to the customers. And that's the vision of SaaS in general and Kato in particular.
And Shlomo, you've been around the industry for quite some time, very successful in terms of your previous entrepreneurship, companies that you founded, taken public, Checkpoint Software, Imperva, both of those companies you have taken public. Do you have plans to do that for Kato?
So I think that Kato can be a very large, leading, next generation security company. And going public is a milestone in that direction. So we're definitely preparing the company to be a public company.
Is it something that you're maybe considering for 2024?
It really depends on the market. You know, we can do so much about our execution, but the market also needs to be there.
The US-China chip war has put big tech in the crosshairs this year. Now, as we look ahead to 2024, who are the winners and losers? And what are some of the other key issues that investors need to keep on their radar? But joining us now, we want to bring in Jiang Shao. He is at Barclays, a China tech analyst. Jiang, it's great to see you here. Thanks so much for taking the time to sit down with us.
Oh, thank you for having me.
So let's talk about the escalation that we've seen between the US and China with the chip wars, the back and forth right now. How effective, or I guess, what's your assessment of the impact so far?
It's a very complex issue, right? In the near term, nobody is a winner. Everybody loses. You see the CEOs of NVIDIA, Intel, and AMD were in Capitol Hill not long ago and saying, hey, we, the leading American semi companies, are losing billions and billions in revenue, which we can reinvest into R&D so we stay ahead of the curve. Right. For the Chinese companies, also they're being hurt as well. Like Alibaba recently, as you know, canceled their IPO for the cloud unit because of the limited access to the latest and greatest chips from some of the US companies.
Has it been effective in terms of what the US is trying to do? They're trying to limit China's access, yet we have seen, and we saw the first sign of it this summer with Huawei with their smartphone, just in terms of not really being able to slow down some of the innovation there.
We have done studies, and we have concluded so far that the export control and technology ban usually doesn't really that work very well. As you can see, to everybody's surprise, Huawei came out, have the Mate Pro 60 phone with a 7 nanometer. And the industry chatter is that they're going to have 5 nanometer within 12 months' time. So they're not that far behind of the US companies. And in a way, the US regulators put the Chinese companies to the corner, in a way counterproductively accelerated their own development effort. So again, we think long-term repercussion is far from clear, but near-term it seems to be everybody is in a lose-lose situation.
Who could potentially be a winner here in that longer-term horizon? Is there anyone that you think could potentially be positioned better than others?
So far, companies like Huawei appear to be winning, right? They were sort of handicapped 3 years ago when TSMC stopped making chips for them, and their market share in the cell phone went from 30% in China to zero. Now the new phone came out 3 years later. To longer term, some of these Chinese companies may actually eventually become a winner out of the chip ban. So we are concerned that the U.S. companies, in the near term, they seem to be hurt. We're worried in the long term they may be hurt as well.
Jiang, you taking a step back here and just taking a look at what's been playing out in China over the last several years. We've been waiting for a recovery post-pandemic. That recovery has been much slower than many of the forecasters had initially anticipated. You cover a lot of the larger cap Chinese tech names. What is your outlook in terms of the fact that how quickly they could potentially recover as we look ahead to 2024? Because a lot of the larger names are still under a tremendous amount of pressure.
Yes, and their fundamentals actually are not doing as badly as their stock price have been doing. But China has had a difficult 3 years. I mean, COVID is just one of many, many problems they have had to deal with. And now the economy is slower than a lot of people hope. And now the government has started to loosen up a lot of the restrictive policies, for example, in the area of real estate. They are now, in a way, pro-business now. I mean, 2-3 years ago, the Chinese government came down hard on some of these internet and tech companies, right? They kind of, in a way, killed the education industry nearly overnight. And they took away the power and incentives of entrepreneurs. Now, hopefully, they have realized you can't really have a vibrant economy without these entrepreneurs, without private-owned enterprises. Now, she was just in Shanghai last week. I think a lot of people took that as a sign that perhaps the most senior leadership in China now is perhaps a bit more pro-business now. We do have relatively optimistic view for China for 2024, and we start to see the green shoots of that recovery already.
What's it going to take, though, to win back investor confidence? Because you mentioned the fact that, yes, the government seems much more pro-business than they had been in past years, but in terms of winning back that investor confidence, what do you think that timeline looks like?
Hopefully it's going to happen next year, and it's going to take a lot to win back investor confidence. I'm just thinking out loud that make an IPO happen, right? The cancellation, the last minute cancellation of an IPO 3 years ago was the beginning of the current downtrend. Make an financial IPO again, and stop meddling too much about the industry in terms of regulations. Let the businesses do what they do the best in terms of innovating, not just on the technology side, but also on the business model side, and protect global investors' interest. Do not come up with these draconian regulations overnight, could destroy our industry overnight.
Jiang, as we look ahead, 2023 has been a wild year for tech. When we keep in mind some of the top themes and some of the movement that we have seen in a lot of these larger cap U.S. tech stock names. As we look ahead, though, to 2024, what's your top investment idea?
Depends on your risk tolerance and your investment style. I think if you say, hey, I don't own any Chinese companies, I want to own safe and sound businesses, and we will say Tencent, right? Tencent is doing great. And all their 3 major lines of businesses are recovering very nicely. Gaming is going to be awesome next year because last 3 years was terrible. Chinese government restarted approving new games again. Their advertising business is on fire because they added new inventory to their advertising business, and also they upgraded in a meaningful way their ad tech and their payment business. The WeChat payment is doing very well. So I think Tencent would be a pick for that kind of style, for that kind of investor. If you are pro-growth and have a little bit of risk tolerance, we like PDD very much. And we think the Temu business, which is a cross-border business, may change the landscape of e-commerce globally and will have sort of wide-ranging impact on companies around the world. And they launched a bit over a year ago. Now their GMV this year is reported to be close to or above $20 billion. And if you are sort of a value investor looking for best reward for the risk you are taking, we think Baba remains a very, very attractive investment. People are already very familiar with the challenges Alibaba has been dealing with. But people often overlook the fact that this company made $27 billion free cash flow in the last 12 months alone. You're paying 4 times of free cash flow, and when you even ignore everything else they own, even if you give zero value to the cloud, to the logistics business, you're paying 4 times of free cash flow. And they're giving you $2 billion dividend, and they're buying back $10 to $12 billion cash stock a year. That's very good return to shareholders.
So Alibaba, PDD, and Tencent, your top ideas here for 2024. All right, well, Jiang Zhao, thank you so much for taking the time to join us here today.
Thanks again for having me.
Software maker GitLab swinging to a profit in its most recent quarter. The company beating the street's expectations, also raising its guidance. And that was enough to send shares to the highest level that we've seen in more than a year. So let's talk about that and more. And for that, we want to bring in the CEO of GitLab, Sid Sijbrandij. Sid, it's great to have you here. Thanks so much for taking the time.
Yeah, thanks for having me.
So let's talk about that most recent quarter that you just reported. It was the third quarter in a row that you had a beat and raise. Revenue up 32% on a year-over-year basis. What's driving that demand?
Yeah, the demand is being driven by software eating the world. Every company has to get better at making software. What companies are seeing is that they now have like 15 different tools to create software, and they have to hop between each and every one of them to get it out the door. We consolidate that onto one platform. They don't have the integration costs, and they get typically 7 times faster in making a change.
So this quarter was a bit of a milestone here, your first quarter that you've reported profitability. Are you confident that you're going to be able to sustain that profitability?
We told the street that for coming fiscal year, we expect to be non-GAAP operating income profitable.
When it comes to what is driving your momentum, there's been a lot of focus on AI. I know you have been investing heavily in AI. What has that done for your business? And more broadly speaking, how much has it, or is it really revolutionizing the software developer world?
It is revolutionizing the software development world, and it's helping out with so many things. If you imagine, like, one prominent feature has been like writing more code, but the AI can help with so many more things, like suggesting reviewers for your code, fixing security vulnerabilities. We've released 14 AI features throughout the development lifecycle to help people that are available to customers today, and that help them optimize their entire development, security, and operations lifecycle.
So what does that future investment look like when it comes to AI? How heavily will you be investing in that space in terms of future opportunities?
Yeah, we're investing heavily to make all these features really, really great, and this 14 won't be the last. There will be more coming.
Let's talk a little bit about some of the stabilization signs that you're seeing in your enterprise business. Certainly was a standout here in the most recent quarter. What does that demand look like going forward, and are we seeing signs of stabilization?
Yeah, we saw some reduced demand in SMB, and what we're seeing is that our software, the consolidation of tools, it works best for the most complex businesses. The more regulatory requirements you have, the more complex everything is. That's when the value of having everything in a single application, a single data store is greatest.
When it comes to some of those opportunities outside of that space, when it comes to some of the macro trends that you're seeing, how are you seeing some of your clients balance this? Because it is a very tough macroeconomic environment. We've been talking to a number of business leaders over the past several days, some of them scaling back in terms of their investment. Are you seeing any signs of that?
Yeah, for sure. Our customers have to save money. And with GitLab, they do that in a couple of ways. They do it because of GitLab, they have fewer software licenses. They save on licensing costs. They save on integration costs. You don't have to duct tape 15 tools together. They save because their people get more effective. They have to hire fewer people. And most importantly, they can execute faster on their cost-saving initiatives because they get software out the door faster.
How are you navigating this uncertain environment as CEO of GitLab? What are some of the adjustments that you're making as a result?
Yeah, we are cost conscious too. We've improved our profitability by 2,200 basis points on a non-GAAP basis year over year.
And how have you been able to do that?
We want to have growth, but responsible growth. So we've grown 32% year over year, but we have a cost conscious culture in the company.
When it comes to some of the risks that are ahead right now for your industry, what would you identify as some of the biggest challenges or biggest headwinds that you see on the horizon?
Yeah, I think AI is the biggest thing. It is a tailwind. I think it makes our software way more useful, but it is a fast developing space, so we got to keep up.
And what are some of those risks associated with AI in terms of what you are doing to try to mitigate some of those risks, some of those headwinds that are very present and something that many business leaders are very closely focusing on?
Yeah, so customers want all the features, the latest and greatest, but they also want to make sure that their data, their code, their IP isn't used to train models that then help their competitors.
AI does cut across, and they're all in very different end markets, but using AI in different ways. So a few of the companies, Motorola for their camera business, and Juniper in their wireless LAN networking business, are really using AI. So they have real life use cases. And then, Dell and Pure Storage and Juniper are busy at work building either, PCs for Dell, servers for Dell, storage, different elements of these large language model networks that we're going to see. So it's really a big driver across the board for these companies.
And Tim, you're a veteran tech analyst here. In terms of the hype that we've seen of AI this year over the last couple of years, have you seen anything like it before?
Yeah, it's pretty unprecedented, and everyone is calling it a hyperscale or cloud 2.0, and it's there's tons of money being invested now, but a lot of the initial money is just going to NVIDIA chips, and we've yet to really see the rest of the build out. It takes a lot of storage and networking and everything else to get real value out of these AI chips that are going out there.
Is it going to be the theme you think that dominates the tech industry at least next year as well?
Yeah, I think it will be. I think it'll shift from from these maybe more towards inference. What's going to happen next? What are the use cases? Are there business models that will support a sustained business here for a lot of these companies? So one of the biggest questions now is, is there going to be a positive NPV to all these investments that are happening? So I think next year will be a lot more about having more use cases that people can point to say, wow, this is a great business model. I want to invest more in this.
Yeah, and that the investments are paying off. Tim, with that in mind, then, who do you think is best positioned at this point?
Yeah, so in my coverage, which is tech hardware, probably the leading AI play would be Arista Networks. They make switches and routers that, the networking element of these data centers, and normally that's 10% or so of the spend. In the AI data centers, it's going to be 15 or more. So more networking intensive. They're a real leader in the space, competing with a Cisco and a Juniper. We think they're really well positioned for next year, and the way their model is likely going to work, 2025 is probably the even bigger year as there's some migration of kind of NVIDIA InfiniBand type of networking towards Ethernet, where Arista is going to be really well positioned.
And Tim, another name that I know our audience is very familiar with, and is a favorite among investors, not one of yours though, and that's Apple. You have had a neutral rating on the stock now for quite some time.
Yes.
Why are you a bit bearish?
Yeah, so Apple's a very tricky one. We're in a period now where the fundamentals are not good. They basically lowered guidance maybe 4 quarters in a row. They don't give official guidance, but numbers have come down 4 quarters in a row, and the stock's up 30-40% this year. So it's not always one as a stock that operates in line with fundamentals. And we struggle with the multiple, the valuation on it. I mean, this before 5-6 years ago, this was pretty steadily a mid-teens multiple stock, and then after a 2-year period, it was a 30 multiple stock. I don't know what really changed. So we still see weakness in iPhone 15. We were just in Asia. It sounds like the 16 next year's version is going to be much of the same, nothing too different in it, which means if we're still in a rough macro environment, could be another year of weakness on the hardware side. And then we always identify services as a great business, but there's some really big risks there. And obviously there's this Google Department of Justice case where there's a very large revenue stream coming in to Apple to be the default browser, and that's potentially at risk now. There's a lot of risks around the App Store being investigated or in about 15 different countries. So a lot of risk to the high multiple part of that business as well.
Going back to what you said about the iPhone 15, not looking at the 16, but 15, from your checks, what does demand look like?
It's fallen. Some of the markets, like China was an important market where Apple was growing double digits in the first half of the year, and then that turned down to double-digit declines the last few months now. So demand is not great. What we saw through COVID for a number of their product lines was just a rapid acceleration of unit growth. So the useful life, if you will, of a phone got shorter, so people were upgrading it more frequently. Now that's passed, and the compares are more difficult. So it does seem like we're still struggling. It's a big company, and they have a huge user base, install base. So yeah, we're going to see flat type of iPhones for the next several quarters, we think.
Welcome back to Yahoo Finance. Well, this year has been a tough year for startups looking to raise money. There's new data out from Crunchbase that shows that early stage funding fell once again in November, down about 34% from a year ago. So here to discuss what the past year has been like and also the state of play for the VC industry, we want to bring in Bilal Zuberi. He's a general partner with Lux Capital. Bilal, it's great to have you here. Thanks so much for taking the time.
Great to be here.
So let's talk about how tough or challenging this past year has been. At Lux Capital, you guys have about $5 billion in assets under management. You're funding, mostly funding science and technology types of companies. So what have you seen some of the trends over the last 12 months?
I mean, look, generally speaking, the last 12 months have been a downer for the industry. There's been fewer financings if you take AI outside a little bit. Lack of IPOs, lack of liquidity for our LPs, and we're very cognizant of that. That has meant a lot of belt tightening for a lot of startups, a lot of changes in operational plans that allowed them to reach profitability sooner. That has meant layoffs, that has meant a lot of change in planning on what the company accomplishes. At the same time, we invest in a few broad areas that we consider to be not only important for society, but also where venture dollars have been flowing in. Things like securing our borders, securing our freedoms, and securing environment. A lot of money has gone into defense tech and continues to go in. We've been beneficiaries of that. We work a lot in increasing productivity of human experience, everything from mobility to the way we do work at home and in our offices. A lot of money has gone into that. AI has been a part of that. We do a lot of investments also in improving human life and condition and reducing human suffering, and there's been a lot of money that's gone into that as well, in drug discovery companies and so on. And frankly, there's a little bit of an M&A that's been happening in the last few weeks and months, so we've been watching that very carefully there, some very large ones. And then last but not the least is unleashing human creativity, where we've invested in companies like Hugging Face and Runway and many others that is really democratizing access to technology. I mean, there's literally, I can sit online and watch television stations now where you can watch completely AI generated movies. And so there's a lot of interesting things happening at the same time. But as I was telling the conference here earlier today, it's always good to be here and with public market investors to really calibrate for private markets as well, and to understand all these companies that are now Series A, C, D, E, whatever stage, they're eventually going to be either public company or get bought by public companies. What will be expected off of them? And I think that is there's been a real dose of medicine that private investors have had to take.
And how have those expectations changed?
So I think 2-3 years ago, it was all about top line growth. Everybody was looking for growth, and where can you find growth? And that was what the VC was known for. And now people are looking for building real businesses and building profitable businesses. There's this thing called profit that startups can aspire to as well. And I think the reality of it is that if 2, 3, 4 years ago, startups used to be very narrative driven, they've become very much metrics and operations driven. And I think that has required VCs and founders and CEOs and executive talent that's been hired over the last 2 years to really hone in and understand how do you actually build real businesses.
And do you think that's the case for AI as well? And I just bring that up because there's been so much focus on that, much of it being hype, much of it being more of an excitement rather than a show me, prove me story, at least up until this point. Is it a little bit different when it comes to some of those AI plays?
Yes, look, AI is still or at least generative AI, which is this new wave that we're going through, is still fairly new. The pace of development has been incredible. In fact, every time I look at it, I'm astounded how fast it's moving and how fast it's moving into every facet of our society. Some of the valuations will remain high and will remain perhaps inexplainable. But even in AI, in the first quarter of 2023, the valuations were off the charts. Frankly, didn't make any sense. And I think the reality was everybody was trying to place their bets. I think people have sobered up a little bit, not as much as they probably should, but they have sobered up a little bit to basically say, are we actually using AI to build businesses and solve problems? And to be honest, in some ways you saw that in the very public drama that happened at OpenAI, right? I mean, the shuffling around that happened was a little bit of, are we a research firm or research-only firm, or are we also a research-only firm that now has shareholders and frankly, even employees that hold equity into the company, and we have to build a business for them.
When it comes to your specific investment criteria, you mentioned some of the companies that you're involved with. When it comes to the AI or those who have exposure to AI, Runway, Hugging Face, just to name a few of those, what is your criteria when you're out there trying to identify that next investment?
So we invest at the intersection of technology and sciences. So we're always looking for where's the cutting edge work happening. So if you look at Hugging Face, it's the cutting edge models developed open source all around the world, made available for everybody to use. Together doing the same thing with enterprise applications in mind and providing the infrastructure to make that happen. Mosaic ML was another company that Databricks acquired in this year just a few months ago. Same idea, building that. Runway ML is cutting edge on visual, creating videos. But then also again, companies like, we've done some, stuff, large investments that are still in stealth mode around, using AI for drug discovery purposes, right? We've done work around using AI for defense tech purposes and national security and cybersecurity. My last investment, we literally wired the money yesterday, is in AI cybersecurity. If AI is being used by not only every person at home, but every employee in your enterprise, and every app, every SaaS app that you're using is using AI, how do you think about securing the data that and IP that you have from leaking out and securing that? So there's a lot of interesting stack that's getting built up. And I think the beauty of it is why you see a lot of VCs interested in it, is that you could be investing in any space at any stage and you will find an interesting AI application there.
From the discussions that you've had, and Hugging Face is one that I'm thinking of, when you talk about the potential for it to go public, are business leaders, are they a little bit more open to potentially entering the public markets as you look ahead at 2024 and beyond?
I think people are very open to making sure that they are building companies in a way that they could go public. I don't think the public markets are open yet, at least not for a lot of companies. So people are still waiting for the larger companies, the Databrickses of the world, the Stripes of the world to go public first. But certainly people are starting to think a lot about, building these companies responsibly, financially responsibly, ethics-wise responsibly, and with global markets, understanding where the regulatory landscapes are that they're going to be playing in. These AI models are being used in every application, right? You're building games with it, you're building dating apps with it, but you're also discovering drugs that are going to go through FDA processes, and you're building, tools of warfare. So you have to be very carefully building that, and I think companies have brought on executives to help them think about revenues and margins and large enterprise contracts. And why you're seeing some of the companies like Hugging Face, Together, and others grow is because they're serving the needs of their customers much more efficiently and effectively.
Well, Al Zuberi, great to get some time with you, general partner with Lux Capital. Thanks so much.
Thank you so much. Great meeting you.
The IPO market failing to gain much momentum in the second half of the year following a group of lackluster IPOs. What does the outlook look like for 2024? For that and more, I want to bring in Kristen Roth de Clark, Global Head of Barclays Tech Investment Banking. Kristen, it's great to have you here.
Thank you. Great to be here.
So let's talk about some of the buzz here at Barclays Global Tech Conference. In terms of the sentiment, what you're hearing from business leaders, what you're hearing from investors, how would you categorize it?
Look, I think there's a lot of optimism. I think we're starting to see investors excited about 2024. It's a great time of year to have the conference because people are really looking forward to next year. We have 1,500 attendees this year. We have the biggest private track and the most impressive private track that we've ever had. And so the main focus is really on a couple themes. Both security and also on AI and applications of AI across a lot of different verticals. And then as you think about, what investors are looking at for next year, a lot of it is on what companies could come public. And with the backlog that we have of IPOs, there are some really impressive businesses that could come out.
Do you think we're going to see much activity next year?
I do. We had 5 tech IPOs this year. We had 2 tech IPOs last year. A typical year, we see 35 to 40 technology IPOs. So there's a huge backlog, and I think the companies that are going to come out are going to be much larger scale. They are going to be much closer to profitability, if not profitable. And so it's easier for investors to kind of lean into some of the businesses that will come out first part of the year.
When it comes to the catalyst in terms of what is going to make business leaders, these companies, feel a bit more comfortable entering the public markets, what do you think that's going to be?
Well, so some of the things we're seeing right now is stability in the market, which gives investors more confidence. So things like a broadening of the, kind of what's working in tech. It's not just the Magnificent Seven. You're seeing, some of the more mid-cap names working. We saw the Russell 2000 up 12%, for example, in November. So that's obviously helpful. We have the VIX below 15 for a period of time, so there's some stability there. And then you've got, the companies that have waited this long to go public. As you start to see some stability, they'll have more confidence to enter the market, have an M&A currency. The other dynamic that we have is private equity firms have been haven't been able to return capital to their LPs as much over the last couple of years, given the slowdown in the M&A environment and kind of the lack of the IPO market. So I think there's a little bit of a catalyst for them to start to return capital to their LPs and exit in one way or the other, either through sales or through taking the companies public.
Kristen, you mentioned there just a minute ago in terms of some of the companies that maybe will likely go public next year, either close to profitability or are profitable. When it comes to some of those biggest names, any of those that you are most excited about or you think will finally take that leap?
Look, it's hard to discuss specific names, but I will tell you there are thousands of technology companies that are private right now. There are about 250 that are really high quality that we're tracking over the next 3 years that could go public. I think some of them will get bought, obviously, and some may choose to continue to stay private, but there's a group of really a significant group of high quality companies, a lot of them in the software space, some internet, some semiconductors and hardware, services, payments, but a lot that are in the software space.
When it comes to AI, the hype, obviously one of the buzzwords here at the conference, is that going to carry that momentum, you think, and as much excitement? Is that going to carry into 2024?
I think it'll carry into 2024 and beyond. It is a massive kind of, movement that's happening in technology that is something that we haven't seen probably since the internet. And I think the most interesting thing is that it applies to a lot of different businesses within tech, and everything from improving efficiency for companies, not just in tech, but across all sectors, and also accelerating the pace of innovation. We're seeing that, for example, in the healthcare world, right, which is with the application of AI.
There's also a lot of focus or a lot of worry, maybe concern, just about the volatility that we could see in the market surrounding the election next year. In terms of then what that means for deal-making activity, what it means for the IPO pipeline, do you see that affecting it at all?
Well, I think that the IPO window next year will kind of be shorter, certainly because of the election. We could see things slow down heading into late September, early October, but I don't know that that's necessarily going to impact the number of companies that get public next year. There will just be more concentrated in the window earlier in the year. We've looked at election cycles historically, and you typically don't see a slowdown in number of companies that get public. It's just more per month during the windows that the market's open.
The biggest risks, the biggest challenges that you're hearing from business leaders in terms of how they're navigating that, what is potentially out in front of them in 2024, what do you think that is?
The biggest question the biggest issue we probably deal with right now with corporates in the boardroom is like thinking about how do we keep from being disrupted, right? And a lot of this is around AI. The one thing that I think AI is driving is accelerating innovation, and which is allowing some startups to try to catch up to some of the mid-cap, larger cap companies. And so I think, if anything, it's a paranoia of what could happen if we're not on our game as it relates to the advancements being made in AI.
And Chris, another driving factor, one of the bigger concerns maybe has been around valuations, the pressure that we saw on valuations, especially over the last several months at this point. Are we starting to see a bounce back in that at all?
We are. Let me give you a software, for example. If you look at the top 10 software companies are trading at an average of 15 times forward revenue. And then, which is great, right? Double-digit revenue multiples is for businesses growing 20% plus. And then you take a look at overall just tech valuations. Tech valuations, the peak multiple of EV to revenue to growth was 1 times. The lowest point we saw was 0.2 times. We're back up to 0.4 times, which is more in line with historical norms.
Kristen Roth-DeClark, great to get some time with you here today, Barclays Global Head of Tech Investment Banking. Thanks so much.
Thank you.